It's 4047 a.m. in Redmond. A software engineer's laptop glows in a dark apartment, refreshing the same stock chart over and over. Microsoft is down another 3% in pre-market. Her options are underwater. That same chart is open on 1,000 screens right now. Retirement accounts, college funds, portfolio managers at their standing desks, all watching the same number fall. Microsoft, the company that was supposed to be the safe AI bet, just had its worst quarter since the 2008 financial crisis. And the story behind that number? It changes everything you think you know about tech investing. Here's what we're going to cover today: the 25% plunge, the $146 billion spending question, and the partnership that was supposed to guarantee Microsoft's AI future, until it didn't. This isn't just about one company. It's about whether the entire AI spending thesis, the bet that trillions of dollars in infrastructure will pay off, makes any sense at all. And by the end of this episode, you'll understand why some investors see a generational buying opportunity, while others see a value trap that could take years to recover. Let's start with the number that made everyone pay attention. Microsoft is down 25% this quarter. That's not a dip. That's not a correction. That's the steepest fall since the financial crisis. Think about what was happening in Q4 2008. Lehman Brothers had just collapsed. The global financial system was in freefall. That's the last time Microsoft stock fell this hard, this fast. But here's what makes 2026 different. In 2008, the whole market was crashing. This time, Microsoft is the clear laggard among big tech. The Magnificent Seven is down 14%. Microsoft is nearly double that. The company that was supposed to be the safe bet, the one with Azure, with Copilot, with the OpenAI partnership, became the cautionary tale. In January, Microsoft reported earnings that triggered a $357 billion market cap loss in a single day. That's billion with a B. Gone overnight. That single-day drop was the largest since 2020. One earnings call, one set of numbers that didn't match expectations, and $357 billion evaporated. So what went wrong? The answer has three parts, and each one matters for anyone holding tech stocks in their portfolio right now. Part 1. The spending. Microsoft's capital expenditures are forecast to hit $146 billion in fiscal 2026. That's not a typo. $146 billion on AI infrastructure alone. To put that in perspective, that's more than NASA's entire budget for 12 years, spent in one fiscal year, on servers and data centers and chips. And here's the problem: Azure growth has decelerated. For the first time in years, Microsoft's cloud business is slowing down at the exact moment they're spending more than ever to build it out. It's like buying a bigger kitchen because you're planning to cook more, and then realizing you don't actually have more dinner guests coming. Part 2. Copilot. Microsoft's flagship AI product was supposed to revolutionize productivity. But user surveys show something concerning. Initial enthusiasm fades once people try alternatives. Retention rates are lagging expectations. That's corporate speak for people are trying Copilot, deciding it's not worth the premium, and switching to other tools. This matters because the entire AI thesis rests on one assumption: that companies will pay premium prices for AI features. If they won't, if AI becomes a commodity like cloud storage, the whole math changes. And then there's part 3, the bombshell. In February, OpenAI launched Frontier, its enterprise agent platform, and then they did something nobody expected. They signed a $50 billion exclusive cloud deal with Amazon, not Microsoft. Amazon. OpenAI argued the new platform fell outside their original Microsoft contract. Microsoft disagreed. Now, whether OpenAI is legally right or wrong doesn't actually matter for our purposes. What matters is the signal this sends to the market. Microsoft bet big on being the exclusive AI infrastructure partner. That exclusivity is now complicated. And complicated and investing usually means risk. The result of all this? Microsoft's valuation has compressed to below 20 times forward earnings. That's its lowest multiple since June 2016. A decade of premium evaporated. Even more striking, Microsoft briefly traded below the S&P 500's average multiple. The biggest tech company in the world, valued like an average business, that hasn't happened since 2016. So here's where we need to talk about what this means for you. Because there are two very different ways to interpret what's happening. Interpretation 1. Microsoft at below 20 times earnings is a screaming buy. This is a company with dominant positions in enterprise software, cloud computing, and gaming. The AI hiccup is temporary. Interpretation 2. This is a value trap. The AI spending will never generate adequate returns. The moat is eroding. And that cheap valuation could stay cheap for years. Here's what the bulls point to. Microsoft still dominates enterprise software. Office 365 has hundreds of millions of paying subscribers. Azure, even with slower growth, is still growing. And some analysts note that institutional investors aren't panicking. Quote, "This is patient capital, not exuberant capital." Exchange balances remain relatively stable while ETF custodians accumulate holdings. But here's what the bears counter with. And it's a harder argument to dismiss than you might think. Investors are selling software stocks over fears that AI startups like Anthropic and OpenAI are creating agents that can replace products made by companies like Microsoft. That's not speculation, that's market behavior. Think about it this way. Microsoft sells Word, Excel, Outlook, tools you use to write documents, crunch numbers, send emails. What if an AI agent could do all of that for you? You don't need to pay for the tool if the agent just handles the task. And that existential threat, that's what's keeping Microsoft's valuation compressed. So what do you actually do with this information? Let's talk about some frameworks that might help you think through your own situation. First, and I want to be careful here, you may want to evaluate your tech exposure. If Microsoft was your core AI play, understand that the thesis has materially changed with the OpenAI relationship evolution. This isn't necessarily a sell signal or a buy signal, it's a review your assumptions signal. The story you bought into may not be the story you own anymore. Second, consider whether compressed valuations represent opportunity or value trap. 20 times forward earnings is historically cheap for Microsoft, but that earnings growth assumption matters enormously. If Microsoft grows earnings at 12% annually, buying at 20 times earnings looks smart. If earnings growth stalls at 5%, that same price looks expensive. The multiple is meaningless without the growth rate. Third, you might want to review your portfolio for companies with similar spend now, revenue later profiles. Microsoft isn't alone in this pattern. The whole sector has the same fundamental question hanging over it. If you've got 50% of your tech allocation in companies betting big on AI infrastructure, maybe that concentration risk deserves a second look. Diversification isn't glamorous, but it tends to prevent regret. For dollar-cost average investors, the people who buy the same amount every month regardless of price, this decline actually works in your favor. You're buying more shares at lower prices. That's the math of averaging. But here's the honest version. Nobody, not the analysts, not Wall Street, not your favorite finance podcast, knows what Microsoft stock will do in 6 months. What we can do is look at what the data suggests historically. Historically, large-cap tech stocks that fall 25% from highs take, on average, 18 to 36 months to recover, when they recover. That's a wide range. Past performance doesn't guarantee future results. And here's where I want to give you the most important framework of all. The question isn't whether Microsoft will recover. The question is whether it will recover before you need the money. If you're 25 and this is money you won't touch for 40 years, a 25% drop might be a gift. If you're 55 and planning to retire in 5 years, the calculation is completely different. The key metric to watch going forward? Azure growth rates. If Microsoft can justify the capital expenditure with accelerating cloud revenue, the stock likely recovers. If Azure keeps decelerating, the thesis breaks. That's what the next 2 earnings calls will tell us. Not whether AI is real. AI is obviously real, but whether Microsoft can turn its AI spending into AI revenue fast enough to satisfy Wall Street. And look, If this kind of market analysis is valuable to you, if you want to understand what these numbers actually mean for your money, consider subscribing. We cover stories like this every week. One more thought before we wrap. Whatever you decide to do with Microsoft specifically, consider using this moment to stress test your entire portfolio. Ask yourself, which of my holdings has a similar risk profile? Which companies are you holding because you believe the thesis? And which are you holding because you're hoping the thesis comes true? Those are very different positions. Microsoft's 25% decline isn't just a story about one company. It's a preview of what happens when conviction meets correction, and how you handle that moment. That's what determines long-term returns. Here's the takeaway. Microsoft is having its worst quarter in nearly 2 decades. The AI spending question is real. The OpenAI complication is real. The valuation compression is real. But so is this. A company that still dominates enterprise software, still runs critical infrastructure for millions of businesses, trading at its cheapest valuation in a decade. Your job isn't to predict whether the stock will recover. Your job is to decide whether your personal situation, your timeline, and your risk tolerance match the opportunity or the risk. As always, this is not financial advice. It's context. Consult with a qualified financial advisor before making investment decisions. But now you've got the information to have that conversation. Make your move.